Welcome to i-TUTOR Economics NCERT series. We were studying Chapter 7, International Economics, and we had covered till the topic Balance of Payment. And today we are going to start with a very new topic, Exchange Rate and Foreign Exchange. Okay. So, first let us understand what is meant by Foreign Exchange or Forex. Forex means Foreign Exchange. Okay. So, think of Forex as the money of other countries. Just like India has rupees, US has dollars and Japan has yen. When countries trade with each other, they cannot use their own currency directly. They need to exchange it into other countries' currency. For example, suppose India wants to buy oil from Saudi Arabia. India cannot pay in rupees. Saudi Arabia wants US dollars or reals. So India must convert rupees into dollars or reals, and this happens in the Forex system. So what does this Forex system do? The Forex system is like the middleman or the bridge between two currencies. It includes methods of payment. That means ways to send money abroad, for example wire transfers, credit cards and demand drafts. Then it includes rules and regulations. That means laws that govern how currency can be exchanged, and it also includes institution facilities. That means banks, central banks and licensed dealers that handle foreign currencies. So, why is Forex important? Yes, it is very important for trade. Why? Because it allows countries to buy and sell goods or services internationally. Then it is important for investment. Why? Because foreign investors can invest in India or vice versa. Then tourism and remittances. Tourists or people working abroad can send money home. In short, Forex is the lifeline of international trade and finance. Without it, countries can't pay each other. Okay, so what is the definition for Forex? Forex is the system or process of converting one national currency into another and of transferring money from one currency into another. So let's break it down. Converting one national currency into another. This means exchanging your home currency for a foreign currency. For example, if you travel to USA, you exchange Indian rupee for US dollars. And what is meant by transferring money from your country or one country to another? This means sending money across borders for trade, investment or personal reasons. For example, an Indian company importing electronics from Japan will transfer rupees converted into yen to pay the Japanese supplier. So why is Forex important? Tell me, why is Forex or foreign exchange important? First reason, as I have already told you, for international trade. Countries need Forex to pay for imports and receive payments for exports. Then investment. Foreign investors bring in money which must be converted into local currencies. Then travel and tourism. Tourists use Forex to spend abroad. And also remittances. People working abroad send money back home, which involves currency and conversion. So in simple words, Forex is like the bridge between currencies. It allows money to flow across countries so that trade, businesses and travel can happen smoothly. Okay, so this is about the definition for Forex. Now, do you know what is meant by rate of exchange? What is rate of exchange? So let's understand the definition for rate of exchange. Rate of exchange or exchange rate is the rate at which or is the external value of a domestic currency. It shows how much of the domestic currency is needed to buy 1 unit of foreign currency. For example, 1 US dollar is equal to rupees 70. What does this mean? It means to buy 1 US dollar, you need to pay 70 Indian rupees. So, how exchange rate is quoted? There are two ways to quote an exchange rate. What are they? Direct quote and indirect quote. Direct quote and indirect quote. What is meant by direct quote? Domestic currency per unit of foreign currency. For example, rupees 70 is equal to 1 US dollar. Here we are saying how much of our currency is needed for 1 unit of foreign currency. Now what does this word indirect quote means? Foreign currency per unit of domestic currency. For example, 1 rupee is equal to 1.42 US cents. Here we are seeing how much foreign currency we get for 1 unit of domestic currency. Okay, now why exchange rate matters? Okay, first one, import and export. If rupee depreciates, that means if there is a fall in value of rupee, import becomes expensive, but export becomes cheaper for foreign buyers. Then second one, travel and tourism. That means it affects how much money you needed abroad. Then investment and trade. It determines returns for foreign investors and cost of borrowing in foreign currency. So the simple way to remember is that direct quote means domestic per foreign. That is how much of our money for 1 unit of theirs. Indirect quote means foreign per domestic. That means how much of their money for 1 unit of ours. So that is about direct quote and indirect quote. Now we are going to learn about equilibrium exchange rate. Okay, equilibrium exchange rate. Definition. So the definition of equilibrium exchange rate is that equilibrium exchange rate is the rate of a country's currency that over a certain period keeps the balance of payment in equilibrium. Okay, I'll explain you. BOP measures, we know that BOP measures all final transactions between a country and the rest of the world, right? And if a country exports and import goods, services and capital in a balanced way, the BOP is in equilibrium. And the equilibrium exchange rate is the currency value that ensures import equal to export plus capital inflows, so the country neither loses nor gains excess foreign reserve. For example, suppose 1 US dollar is equal to rupees 70 keeps India's export plus foreign investment is equal to import plus payment abroad over a year. Then this rupees 70 per US dollar is the equilibrium exchange rate. And if rupee falls to rupees 75 per US dollar, export rise and import falls and BOP moves back towards equilibrium. And if it rises from rupees 70 to rupees 65 per US dollar, export falls and import rise and BOP adjust. So the key point to remember here is that equilibrium exchange rate is dynamic. It can change with trade, capital flows and global economic conditions. Okay. Now, determinants of equilibrium exchange rate. What are the determinants of equilibrium exchange rate? So, the equilibrium exchange rate is determined in the forex. What is meant by forex? Foreign exchange rate. So, the equilibrium exchange rate is determined in the forex market just like any price in economics. Through demand and supply. So demand for forex means how much foreign currency like US dollar people or business wants to buy. For example, importers, travelers or investors who need dollars will create demand for dollars. And what is meant by supply of forex? How much foreign currency is offered in the market. For example, exporters or foreign investors bring dollars to India creating supply. And the exchange rate is determined at the point where demand equals supply. So let's look at the graphical representation here. And the y-axis, you can see the exchange rate. Okay. And x-axis, quantity of forex in dollars. And DD is the demand curve, SS is the supply of dollars. And E is the point. It is the intersection of DD and SS and it is the equilibrium point. Then where is P2? This is P2 and it is the exchange rate at equilibrium. And let's look at it. At P2, what happens? The quantity of dollars demanded is equal to quantity of dollars supplied. Right? Quantity of demand is equal to quantity of dollars supplied. If exchange rate rises above PT, that means P2, that means if it become P1, excess supply of dollars happens. Excess supply of dollars happens and rate will fall back to equilibrium. And if exchange rate falls below P2, that means if it becomes P3, what happens? Excess demand for dollars and rate will rise back to equilibrium. So the key idea here is that just like prices in a market, exchange rate adjusts automatically through the interaction of foreign demand and supply to restore equilibrium. Okay. Now, types of exchange rate systems. Exchange rate systems describe how a country's currency value is determined against other countries. Broadly, there are two main types with a hybrid system used by some countries like India. What are those? Fixed exchange rate system and also flexible exchange rate system. So, fixed exchange rate system is also called pegged exchange rate system. Pegged exchange rate system. So, a fixed exchange rate system is one where the government or central bank sets and maintains the value of its currency at a fixed rate against other currency or a basket of currencies. And the key points to remember here are, it is also called stable exchange rate or pegged exchange rate system. And under the gold standard, currencies were pegged to gold. For example, if rupees 1 is equal to $0.014, that is fixed, it remains at that rate until the government decides to change it. Okay, and what are the advantages of this fixed exchange rate system? It provides stability in international trade and investment. Then it reduces exchange rate risk for businesses and so on. And what are the disadvantages? Just think about that. Yes, it requires large foreign exchange reserve to maintain the peg. And also government cannot easily adjust rates during economic crisis. So that's about fixed exchange rate system or pegged exchange rate system. Now what is called flexible exchange rate system? It is also known as floating exchange rate system. A flexible exchange rate is determined freely by the market based on demand and supply of foreign currencies. And the key points to remember here are, it is also called floating exchange rate system and there are no fixed or predetermined rate. It fluctuates depending on market forces. For example, if demand for US dollar increases, the value of rupee falls, and if demand falls, the rupee appreciates. And do you know what are the advantages of flexible exchange rate system? Yes, it automatically adjusts to balance of payment changes, and also there is no need for large foreign exchange reserves. Now what are the disadvantages? It can be volatile, making international trade and investment risky. Okay, there is one more exchange rate system, that is called managed floating exchange rate system or hybrid system. Some countries like India, they follow a managed or dirty float. Exchange rate is mostly determined by market forces, but the central bank intervenes occasionally to avoid excessive fluctuations. For example, RBI buys or sells dollars to stabilize the rupee during high volatility. So that's all about the types of exchange rate systems. What are those? Fixed exchange rate system, flexible exchange rate system, and also managed floating exchange rate system. So this managed floating exchange rate system is a hybrid form of fixed and flexible exchange rate systems. Now we are moving to the next topic, that is types of exchange rates. Exchange rates can be classified into four main types. NER, that is nominal exchange rate, RER, real exchange rate, then nominal effective real exchange rate, and also real effective exchange rate. First one, nominal exchange rate or NER, NER, nominal exchange rate. What is meant by that? The nominal exchange rate is the rate at which one currency can be exchanged for another. It is the face value of a currency in terms of another currency. For example, suppose $1 is equal to rupees 75, then the nominal exchange rate is equal to 75 by 1. Okay. This is bilateral nominal exchange rate because it involves only two currencies. Now what is meant by real exchange rate? The real exchange rate adjusts the nominal exchange rate by the price levels in two countries. It shows the purchasing power of one currency relative to another. Okay, so the real exchange rate is always equal to price level in India, that is equal to price level in abroad, that is equal to nominal exchange rate. Okay. For example, price of a pen is suppose 50 in India and price of the same pen is rupees $5 in USA. So what is the nominal exchange rate here? 75 divided by US dollar, that is, so 75 divided by US dollar, that is 7.5, that is 7.5, that is 75 into 5.50. So if RR is equal to 1, the currency are at purchasing power parity. So that is PPP. If RER is greater than 1, domestic goods are relatively cheaper, and if RER is less than 1, domestic goods are relatively expensive. Hope you understand. Now, do you know what is meant by NER or near nominal effective exchange rate? NER is the weighted average of a currency's nominal exchange rate with all major trading partners, and weights are based on trade shares. And the purpose of NER is to give a better idea of a country's overall external competitiveness than a bilateral rate. And what about RER or real effective exchange rate? What is meant by that? RER adjusts the NER by relative price levels between the home country and its trading partners, and it shows the competitiveness of a country's good and service in international market. Okay, suppose RER is greater than 100, that means domestic goods are more expensive and exports may decrease. And if RER is less than 100, that means domestic goods are cheaper and exports may increase. Okay. So that's about the different types of exchange rates, NER, RER, NER and RER. Okay. Now, what are the determinants of exchange rate? What are the determinants? Exchange rates are influenced by many factors that reflect a country's economic performance, stability and international relations. So let's go through them step by step. First one, differentials in inflation. So inflation and currency value are inversely related. Okay, inflation and currency values are inversely related. So if there is lower inflation, purchasing power rises and currency appreciates. And if there is higher inflation, purchasing power falls and currency depreciates. For example, if India's inflation is 4%, US inflation is 6%, then Indian rupee gains value relative to the US dollar. So that's about differentials in inflation. Now next one, differentials in interest rate. What is meant by that? Differentials in interest rate. So the key idea here is high interest rate attract foreign capital, and that leads to a rise in currency value, and lower interest rate lead to less foreign investment, that leads to a fall in currency value. For example, if RBI increases interest rate from 8% rate to 8%, while US rate remains 5%, foreign investors will buy more Indian currency assets and Indian rupee appreciates. Okay, that's about differentials in interest rate. Next, public debt. Here the key idea is that high public debt can scare off foreign investors because it may lead to inflation or default risk, and more debt means less investment and currency depreciates. For example, a country borrowing heavily internationally may see its currency fall against the US dollar. Next one, terms of trade. So terms of trade is the ratio of export price to import price. Better terms of trade leads to higher demand for exports and currency appreciates. For example, if India exports steels at higher prices and imports oil at lower prices, what happens? Indian rupee strengthens. Next one, political and economic stability. So stable politics plus strong economic performance attracts foreign investment and currency appreciates. Political turmoil or economic mismanagement leads to currency depreciation. For example, countries with stable governments like Switzerland, they have strong currencies. Okay. Next one, recession. So during recession, interest rates are low and foreign capital inflow slows and currency depreciates. For example, during 2008 financial crisis, many currencies weakened against the US dollar. And the last one, speculation. So investors try to predict future currency movement to make profit, and if expectation of currency rise, that leads to high demand and currency appreciates, and if there is an expectation of currency fall, that leads to selling of currency and currency depreciates. For example, traders buying Indian rupee because they expect it to rise against US dollar, this Indian rupee appreciates. And there is one more thing, global political and economics dominance. Countries with global influence can affect exchange rates via sanctions or trade policies. Strong geopolitical power leads to more trust in currency and currency appreciates. For example, US dollar is strong partly because the US has global economic and political influences. So these are the determinants of exchange rates. Okay. Now we are going to a very important topic, that is foreign direct investment and trade, FDI. Do you know what is meant by FDI or foreign direct investment? FDI occurs when a company or individual from one country invests in business assets like factories, plantations or infrastructure in another country. For example, a Japanese car company setting up factory in India. That is an example for FDI. So how FDI and trade are connected? First, FDI boosts trade volume. That is, when foreign companies invest in a country's natural resources or industries, they often need raw materials, machinery or other inputs, and this increases imports from other countries. For example, FDI in plantations requires machinery, fertilizers and seeds from abroad, and that leads to an increase in import trade. Second one, FDI can substitute foreign trade. That means sometimes instead of importing goods, a foreign company sets up local production, and this reduces the need to import while still meeting domestic or export demand. For example, a smartphone company producing phones in India rather than importing from China. And the third one, FDI is influenced by trade income and regional integration. Countries with higher export earnings attract more FDI because investors see profitable opportunities. Regional trade agreements like ASEAN or EU, they all encourage FDI. And also FDI supports economic growth. This FDI provides capital, technology and know-how needed for development programs. It helps in importing essential goods like capital goods, then technical know-how, raw materials, scarce consumer goods, etc. So FDI fills the trade gap when export earnings are not enough to pay for necessary imports. For example, India might not earn enough from exporting textiles to buy high-tech machinery, and FDI brings the machinery and expertise needed for development. So what is FDI? FDI is when citizens or government of one country, called a home country, invest in business, industry or projects in another country. It is called host country. For example, a Japanese car company opening a factory in India is a foreign direct investment. So what is FDI was foreign investment? Foreign institutional investors. Do you know what is meant by foreign institutional investors? FII. They invest in financial assets, okay, like stocks and bonds in another countries without taking part in management. For example, an American mutual fund buying shares of Indian companies. But FDI involves real investment in industries, factories or infrastructure, and investors usually has control or active role in business operations. Why do countries encourage FDI? FDI is encouraged because there is a foreign exchange shortage. So developing countries may not earn enough foreign currency through exports. So FDI brings in capital and foreign currencies. Then employment generation. That is, FDI creates jobs for locals in factories, offices and industries. Then economic development. FDI brings technology, skills and investment which accelerates development faster than relying only on imports, and also preference over imports. Many developing countries prefer FDI because it produces goods locally instead of importing them. So this FDI can have mixed impacts. What are the boons of FDI? It creates jobs, improves technology and increases export. And what are the bans? It can affect local businesses, profit repatriation to home countries or create economic dependence. So the impact differs for different sections of society, which makes it a good decision, which makes it a good discussion topic. Okay. Then there is also hidden agenda for fund bank policies. Policies of institutions like IMF and World Bank often create high demand for US dollars, which strengthen the US dollar. This can indirectly affect developing countries' trade and debt. So it is an advanced point for discussion about global economic influence of major financial institutions. You can read about it in standard books. Okay. Now, meaning of FDI. FDI is an investment made by company or individual from one country into another business or industry in another country with a significant degree of control and participation in management, as we have already told. And we should remember some key terms here. There is control and management in FDI. Unlike simple investment, FDI involves active involvement in the running of businesses. For example, a Japanese car company setting up a factory in India and deciding how it is run. Then multinational enterprises. FDI is mostly carried out by multinational corporations which operate in more than one countries. So remember these two terms while defining FDI. Okay. Now, objectives of FDI. Foreign direct investment is not done randomly. It has clear business objective. So we can explain it in detail. First one, sales expansion. Companies invest in foreign countries to increase their market size. For example, Coca-Cola, they set up production units in India to reach more consumers locally rather than exporting all products from the US. Second one, acquisition of resources. FDI allows companies to secure important resources such as raw materials, skilled labor, technology or natural resources. For example, a mining company investing in Australia to access iron ore. Third one, diversification. Companies invest abroad to spread business risk across different markets. For example, a company operating in both Europe and Asia can balance losses in one region with profit from another. And the fourth one, minimization of competitive risk. By entering foreign market, companies reduce threats from competitors and gain strategic advantage. For example, setting up a branch in China may prevent competitors from dominating that market. So that's about objective of FDI. Now, advantages of FDI. FDI is a powerful tool for economic growth, especially for developing countries like India. Let's break down the main advantages in a simple way. Okay, first one, it boosts investment, income and employment. FDI increases capital in the host country. So when there is more capital, it leads to more factories and that leads to more jobs and higher income. Second one, technology transfer. FDI brings in modern machinery, skills and techniques. For example, Japanese car companies in India introduce advanced production methods. Okay. And the third one, government revenue. Taxes on foreign companies' profit and royalties generate revenue for the government. Fourth one, reinvestment of profits. Some profits are plowed back into expansion, modernization and related industries, boosting the overall economy. Then, managerial expertise. FDI introduces professional management practices and sophisticated techniques, and local managers learn and improve their skills. Sixth one, it improves BOP or balance of payment. It improves BOP or balance of payment. FDI can help increase export and reduce import. This eases BOP disequilibrium by bringing in foreign exchange. 7.1, it encourages competition. It increases or encourages competition. FDI introduces new competitors which breaks domestic monopolies and improves efficiency. Then 8.1, greater social returns. What does this mean? If FDI adds more value to output than the foreign capital invested, the social benefits exceeds private gain and contributing to national development. Ninth one, it fills savings and foreign exchange gaps. FDI provides capital and foreign exchange needed for national economic development. 10th one, it stimulates domestic industries. This means it encourages domestic firms to invest in ancillary and supporting industries in collaboration with foreign firms. 11th one, it encourages regional investment. That is, FDI flowing into a developing country can encourage local entrepreneurs to invest in other developing countries. For example, Indian firms investing in Nepal, Uganda, Ethiopia and Kenya. So these are the advantages of FDI. What are the disadvantages of FDI? While FDI brings many benefits, it also has certain drawbacks that developing countries need to be aware of. What are they? Flow of high profit areas. That is, foreign investors often invest in sectors that are highly profitable, ignoring priority or essential sectors of the economy. For example, luxury goods, they get more investment than basic industries like agriculture or rural infrastructure. Then inappropriate technology. That is, the technology brought by foreign firms may not suit local needs, market size, resource availability or stage of development. For example, advanced machinery meant for large scale production may not fit small scale domestic markets. Third one, adverse effect on BOP. That is, when foreign firms repay dividends, royalties or fees back to their home countries, it can drain foreign exchange. And if this outflow exceeds what they bring in as investment, it harms the BOP. Fourth one, political interference. In some cases, foreign investors may influence national policies to protect their interest. Fifth one, unfair trade practices. That means foreign firms might engage in monopolistic or unethical practices, harming local competitors and consumers. Sixth one, harm to small and medium enterprises, that is SMEs. What is meant by that? Local SMEs may be weakened or even destroyed due to competition from well-funded foreign firms. Seventh one, creation of monopolies. This FDI can sometimes lead to market concentration, reducing competition and creating monopolistic or oligopolistic structure. And the final one, cost of encouraging FDI. Government may spend subsidies, tax breaks or incentives to attract FDI, which can be costly. Okay, that's about the disadvantages of FDI. Now, foreign direct investment in India. Do you know what is the background of FDI in India? Early 1990s were a turning point for India's economy. Economic reforms liberalized the Indian market, making it easier for foreign investors to invest in India. Since then, FDI inflows have steadily increased, bringing in capital, technology, management expertise, and access to international markets. So, what are the key sectors benefiting from FDI? India has welcomed FDI in both traditional and modern sectors. Major sectors included are financial sectors, both banking and non-banking financial companies. Then insurance, life and general insurance, telecommunication, that is mobile network, broadband, IT infrastructure and so on. Then hospitality and tourism, that is hotels, resorts, travel services, etc. Then pharmaceuticals like drug manufacturing and research, software and information technology like IT services and software exports. Then natural resources like coal, lignite and mining of iron, manganese, chrome, gypsum, sulfur, gold, diamonds and copper. So FDI inflow trend is from 1990 to 91, almost $97 million, $97 million. 2004 to 5, it increased to decreased to $5,535 million, and 2011-12 $32,955 million, and 2006 $44 billion. So in 2017, $40 billion, that is slight decline as per UNCTAD World Investment Report 2018. So the observation here is that despite fluctuations, India has remained an attractive destination for foreign investors. And what are the advantages for India? free flow of capital into key sectors, then access to advanced technology and management expertise, integration into global supply chain and markets, and also boost to employment and economic growth. So these are about the FDI in India. So now we are going to the last topic, that is not topic, we are going to the summary of this chapter. We have learned about international economics. What is international economics? A branch of economics that studies trade and economic interactions between nations, and it focuses on how trade benefits countries and influence their economic development. Then we have learned about the theories of international trade. We have learned about Adam Smith theory and also David Ricardo's theory. Adam Smith's absolute cost advantage, that means trade benefits when countries specialize in goods they can produce more efficiently. And David Ricardo's theory is comparative cost advantage theory. He said trade can benefit even if one country is less efficient in producing all goods. And modern theory of HO, it said that it explains trade based on differences in factor endowment. And also we have learned about major areas of discussion in international trade, that means gains from trade, then terms of trade and BOP. We have learned about exchange rate and different types of exchange rate, then foreign investment, foreign direct investment by foreign entities which control and manage participation. And it also helps economic development, especially in developing and less developed countries, by providing capital, technology and employment. Then we learned about global inequalities in trade and also international economic organizations and trade blocs. This International Economic Organization trade blocks we will be learning in the next chapter, that is SAARC, ASEAN, BRICS and so on, that we will be learning in the next chapter. Okay, so that's all about this chapter. Hope you understand. Thanks for watching. For more related contents, do like, share and subscribe.